want to start, if we can, with the basics. So when we just talk about SPACs to start with, obviously SPACs started life really in the US, and we know we've got this vehicle which can be used to acquire an entity and thus make it listed. So if you can just give us absolutely ground up, just to start with, an explanation of what a SPAC does from kind of just the initial inception, and then we'll start to build on the various elements and intricacies which I'll bring in as we ask the questions as we go through.
Yeah, so I think that on a really basic level, a SPAC, which is special purpose acquisition company, is effectively like a shell company or a holding company that's usually started by an investor of some repute, although lots of other people have subsequently started them. They will raise money from other investors, and the company, the SPAC, will then be listed on a stock exchange, and its goal is to effectively acquire another company. Usually they have a limitation of a time limitation. They have 2 years to acquire another business with the money they've raised. And once they've acquired that other business, it means that it will then be listed on the stock exchange. So in very simple terms, that is what they do.
Fine. So if we just see this to start with, what I'd like to do is just look at this to start with from the investor's perspective, and then we'll turn it to the kind of sponsor, or if you like, leader, if you like, of the SPAC's perspective. So if we just put our head around the investor side of it, typically, who are the investors, and what do they get out of this investment in its first instance?
Yeah, so this is arguably one of the more controversial aspects of the SPAC structure. So effectively, when you buy into the SPAC at the start, in its equivalent of its listing on the stock exchange, you acquire units. So 1 unit is usually $10. And for $10, you get a share, but you also get a warrant. So the warrant will, in the future, enable you to buy more shares at a set price. It's usually $11.50. And the reason I say it's a bit controversial is those early investors are able to, when the merger takes place, they're able to redeem the shares they bought, regardless of whether they want the acquisition to happen or not. So they buy the shares for $10 at the beginning. When the acquisition takes place, they're able to buy them, they're able to redeem them. So they're able to give their shares back, get $10, but keep the warrant. And what a lot of people are doing is redeeming their shares and then selling the warrant. So it's almost like free money for them.
Albeit that they've had the money invested, the $10 invested over the period of time which the SPAC was in play.
Yeah, so there's been one study from early 2020 which effectively found that a huge number of hedge funds were using this mechanism to basically get quote unquote free money and getting quite good returns off it. Having said that, not everyone is doing that, and some people will invest with a view to buying into whatever company it is that's acquired. And I think what we've seen on our platform and just across the market is that if the person starting the SPAC is sort of respected, and it could be, let's say Bill Ackman's SPAC was very well received. People sort of trust what they're going to do and believe that the company they're going to acquire will provide good returns in the future, so they're more likely to hold on to it. So you sort of have those two dynamics at play. You have some people that are just sort of almost gaming the system and buying it just so they can make a quick buck in some way. And you have other people who are genuinely
I'm interested in the long term.
Yeah. I don't know if you want me to talk about the secondary market, but the thing, another from our point of view as well, I think part of the interest in this process for investors who don't buy the shares at the beginning, but who then subsequently buy them on an exchange, is that a lot of them have felt that they lose out in the traditional IPO process on the IPO pop. So investment banks in a regular IPO process will often buy shares from the IPO and then immediately go onto an exchange and sell them at a much higher markup. And obviously, if you already own shares in the SPAC, before the process has been complete, then when it's announced, if there's any subsequent pop, then you're there to take advantage of it. Whether or not that's actually, whether or not that logic actually holds true in reality is sort of debatable, but certainly there are people who come into it with that mindset, particularly in the retail market, and who feel that they've sort of been let down over the years, and this is why they find SPACs quite appealing.